Ready for a deep dive into the stock market? We're looking at mapsignals.com today, and they've got some fascinating analysis.
Yeah, they're really onto something with this thing they use, the big money index.
BMI, right?
Exactly, the BMI. They use it to track what big investors are doing, see if they can spot those moments when, the market might be about to take a turn.
So they're like market detectives, looking for clues.
That's a great way to put it. They're looking for those subtle hints that most people miss.
And are they any good at it? Like, have they had any successful predictions?
Oh, absolutely. In fact, just about a year ago, October 17th, 2023, Map Signals predicted a stock market rally.
Okay, bold move. Were they right?
Right on the money. Since then, the S&P 500 and the NASDAQ 100 are both up 35%.
Wow, 35%. That's a heck of a rally.
It really is. They really called that one.
So how does this BMI work? Is it some kind of secret formula?
Well, it's not exactly a secret, but it's definitely insightful.
Do tell.
So basically, the BMI is a gauge of big money activity. It tracks those big institutional investors, the ones moving millions, even billions of dollars.
So when those whales make a move, the BMI picks it up.
Precisely. And it's not just about individual moves, it's about seeing patterns. Are these big players buying? Are they selling? And what does that tell us about where the market might be going?
So it's all about reading the signals, those big money signals.
You got it. And one of the key signals they look for is something called oversold territory.
Oversold. Does that mean like a sale at the stock market?
That's a great way to think about it. When prices drop to a certain point, those big investors, they see an opportunity.
They swoop in like bargain hunters.
Exactly. It's like a giant clearance sale for them. And get this, since 2018, there have been 7 times when the BMI has flashed oversold.
7 times. What happened?
Every single one of those times led to a 12-month average return of 26.1% for the S&P 500.
Wow, 26.1% every single time. That's incredible. Are these institutional investors just really good at timing the market?
It's not just about timing, it's about recognizing value. They have the resources, the research, to spot those opportunities before the rest of us.
So if you'd bought during one of those oversold signals, you'd be sitting pretty right now. But markets don't just climb forever, right? What about when things get a little, overheated?
Yeah, what goes up must come down, as they say. And that's where overbought territory comes into play. Basically the flip side of oversold, right?
So instead of a sale, everything's suddenly gone way up in price.
Exactly. And that's actually what Map Signals BMI is saying right now. As of today, October 17th, 2024, we're officially in overbought territory.
Oh, okay. So time to panic.
No, not necessarily. It's not a guaranteed crash or anything.
More like a yellow light. Proceed with caution.
Exactly. A signal to pay attention, see what develops. And the historical data here gets interesting, particularly, for you, really. Since 2014, when the BMI has gotten into this overbought zone, it's stuck around for an average of almost a month, like 21.88 days to be exact.
So we could keep riding this wave a bit longer, maybe a few more weeks of the market going up.
It's definitely possible. Markets can be irrational longer than you'd think. But, and this is key, historically, when that BMI drops back below 80% after being overbought, well, it's not always pretty.
Okay, now you've got me nervous.
Yeah.
What happens when that wave breaks? How bad are we talking?
Well, both the big stocks, large cap, and the small cap ones, they tend to see some negative returns after that drop below 80% in the weeks and months that follow.
So it's not just a quick dip in recovery. There's like an aftershock.
Kinda, yeah. Think of it like when those big investors, they start shifting direction. Creates a ripple effect, takes time to stabilize. For example, a week after the BMI dips below that 80% after being overbought, the S&P 500 is usually down, on average, 0.9%. And the S&P Small Cap 600, that one's down 1.3%.
Okay, a noticeable drop, especially for the small caps.
Yeah.
But what about further out? Does it bounce back quickly or?
That's the thing, it usually doesn't. A month later, the S&P 500 typically down about 1.6%, and small caps get hit even harder, around 2.7% down.
Oof, that's getting significant, especially if you're heavy into small caps. But this info, it's valuable, right? If you know this pattern's coming, you could adjust your strategy maybe.
Absolutely. And it's not just about avoiding losses. Remember those oversold signals we discussed? They often happen after overbought periods.
So the market dips, and that creates buying opportunities if you're ready for them.
Exactly. It's all about understanding the cycle. You can't stop the waves, but you can learn to ride them.
That's a great way to put it. Not about freaking out, but being informed, prepared.
Exactly. And those who are prepared, well, they're usually the ones who benefit most from those dips. Every wave has its high point and its low point, and knowing that rhythm, that's what makes all the difference.
Map signals even uses a surfing analogy, don't they?
They do. You can't stop the waves, meaning you can't control those market ups and downs, but you can learn to ride them, meaning you can navigate them and come out ahead, potentially.
So for everyone listening, the question is, are you hanging 10 or are you going to get wiped out?
That's a powerful image. Gets right to the heart of it. Knowledge is power. And knowing these market cycles, that's how you make smarter investment choices.
Couldn't agree more. Big thanks to Map Signals for, well, giving us so much to consider. And to our listeners, keep riding those waves. We'll catch you on the next deep dive. So just to be clear, we're not saying anyone should try to time the market perfectly or, like, predict the next crash.
No, not at all. It's more about, like you were saying, understanding the natural rhythms of the market.
Like those tides, right? They go in and out.
Exactly. It's about recognizing those bigger trends.
And if we can use things like this BMI to get a sense of where we are in those cycles.
Then you're in a much better position, right?
Absolutely. Because then you're not just reacting to every little bump in the road.
You're prepared. You're informed. You know when to maybe hold on tight, ride that wave a bit.
And when to maybe adjust your stance, right?
Yeah.
So you don't get knocked over.
Exactly. It's all about being agile, being adaptable. And honestly, it makes the ride a bit more enjoyable, don't you think?
Definitely. When you're not constantly worried about wiping out, you can actually appreciate the scenery a bit.
I like that. It's about understanding the currents and navigating them effectively.
Couldn't have said it better myself.
Mm-hmm.
Well, this has been a fascinating deep dive. Really appreciate you breaking it all down for us.
My pleasure, really. Always happy to share these insights, especially when they can potentially make a difference.
Absolutely. And for our listeners, if you're interested in learning more about map signals and this big money index, we'll be sure to include a link in the show notes.
Always good to do your own research, right? See what you think.
Always. And remember, everyone, knowledge is power, especially in the world of investing. Until next time, happy investing.